In the context of investment decision making, businesses would always tend to assess the viability of a project in order to determine whether the project is worth accepting based upon payoff measurement techniques such as net present value (NPV). However, due to the nature of the forecast information included in the calculations of NPV, most of these forecast items are largely uncertain and subject to changes. So therefore, it is common and crucial for businesses decision maker in challenging the validity or the accuracy of the resulting payoff by asking the questions, what if? The forecast items turn out to be less desirable. Will the project still remain viable? Will the NPV still remain in the positive zone that serve to be an evidence of accepting the project? And to answer these questions, this gives rise to the needs of understanding and assessing the sensitivity on the project's payoff based upon the uncertainties arising from the forecast information. Hello, my name is Tze Kang, the expert tutor for financial management. This topic explainer is about sensitivity analysis. In these videos on sensitivity analysis, or sometimes it may be termed what if analysis, is mainly referring to the ACCA resources, primarily resources from Study Hub. For learning purpose, I would suggest candidates to refer to each of the respective chapter. For this topic explainer, it is chapter 7 that is mainly referred to, particularly section 7.2 about sensitivity analysis. Apart from learning, it is equally important for students to spend sufficient time in practicing the questions. So, for practice purpose, quizzes as well as practice questions, which mainly comprising in the form of objective test format of the question, it's worth spending time to get yourself familiar with it before turning into practicing the real exam questions. Towards the end of the learning, it will be important for you to recap the understanding, the fundamental terminology on terms that come across in the study. In the flashcards, explanations on the meaning of terms such as sensitivity analysis were clearly given as shown on the screen. Last but not least, ranges of technical articles that may appear in the near future, as well as ranges of past exam questions found in practice platform, and finally, examiner report. These are the essential and crucial informations for learning purpose for candidates to improve the exam success. In this session of the video, I will take you through first to understand what exactly is sensitivity analysis as what gives rise to the needs for businesses in performing and undertaking such analysis, followed by some of the technical demonstrations in performing sensitivity analysis in the context of decision making. Once the findings derived from sensitivity analysis, what exactly are the usefulness and the purposes of such findings? And finally, apart from the usefulness and the purpose of the findings from such analysis, one should also be aware on the underlying assumptions, which is more reflecting the limitations on such application. And finally, guys, there will be demonstrations based upon activities, exercises that found in the study hub, as well as in the practice platforms with some of the past exam questions as illustration. So let's start looking into 1A, what exactly sensitivity analysis is all about. Here is the findings. The sensitivity analysis represents measurements regarding effects on the payoff that is largely measured by techniques such as net present value, NPV of a particular project being one of the target proposed investment, and how exactly these payoff be affected given changes, variabilities in one of the particular variables that included in the calculations of NPV. The common items of the variables are such as selling price, variable cost price, sales volume, value of fixed costs, discount rate in use, and many others, not to mention all examples such as initial investment, scrap value, and last but not least, the project lifespans. All these are the variables that incorporated in the calculations of NPV that may subject to a certain extent of changes and variability. Such measurement on the effect pertaining to the payoff are mainly relating to the estimation on the extent of changes, which largely expressed in terms of percentage regarding a specific variable that may lead and render a possible change on the original decision made pertaining to a particular investment on the project. Take for instance, based upon the current estimates of variables, it can be selling prices, variable cost price, fixed cost, many others as mentioned a moment ago, that will give rise to present value on each of the specific variable item. And these present value will in turn incorporated into the resulting NPV based upon the original or the current estimate. However, the nature of forecast tells us it is possible when times come, such forecast value may not turn out to be as planned. So, in the event of what if, a different set of revisions on the estimate were to arise, so that represented by X2, that will hence give rise to a separate and a different value of PVs. And these PV will then lead to a different amount of net present value. Based upon the explanations earlier, the measurement of such changes on the variable would possibly render a change in the original decision on the project. So what does it mean by that? If the original estimates of NPV, it turns to be positive, the general rules on decision making is a positive NPV would therefore justify a recommendations to accept the project given the fact that these projects were believed to generate an add-on value to shareholders. However, given the changes that may take place on the specific variable that may lead to a possible change in the decision, decisions will only be changing when NPV, originally it was at positive value, and when it turned to the critical value of nil or zero, that is when the decision of accepting the project is about to change from accept to reject if net present value decline further below zero. So zero value of NPV represent the critical value that determine the change, the turnaround of the decision originally made. So therefore, in this context, what we would like to measure is the extent of changes from value represented by x1 to the revised value that represented by x2. How many percent of such changes indicate? That is exactly what the measurement of sensitivity analysis is all about. So, why would businesses need to undertake such analysis to identify percentage of changes on the variable that may render a change in the decisions originally made? Let's take a look at the answer for 1B. Here it is, guys. Should a potential investments in the projects involved with ranges of relevant information and each of which may contain ranges of unlimited possible outcomes. In other words, any values may be possible, and this, for your knowledge, it is termed uncertainty of data. With this kind of highly uncertain outcome, the payoff that measured by NPV derived from these uncertain relevant information will be uncertain too. And these give rise to hence the decisions that make it therefore uncertain, or it is no guarantee to be a best deal or the best decisions that made. With these dilemma, it is important and crucial for decision maker to ask the following questions. What if certain items of the cash forecast is different from what is being originally estimated? What will then happen to the project payoff, namely what will happen to the resulting NPV? It is likely that everyone will be able to visualize when or should the cash estimate in the forecast is different from what is planned, the resulting NPV would have changed. So what we want to see and know is the percentage of the changes that may render this NPV to reach the critical value of 0. In simple, these studies, it's all about what's the sensitivity on the project's payoffs given the changes in one of these variables. So, knowing the needs of performing sensitivity analysis, here comes the next questions. How are we to carry out such analysis? Well, guys, here are the main steps involved in performing a sensitivity analysis on the project. First and foremost, the very first step is always to derive the project's NPV based on the original estimates on all relevant information such as selling prices, variable cost price, sales volume, fixed cost, many others. From the resulting NPV, that would drive and lead to a tentative decision that made. Namely, should such NPV turn out to be positive, the project is said to be acceptable, vice versa. Next, to perform a sensitivity analysis, the ranges of questions will be asking on what if each and every of those variables is changing. So from there, the second step of the calculations will come in to measure the percentage of change. At this point, let's denote by X%. Let's measure the reading on the X% required from the specific variable that may lead the NPV to go to 0 as the critical value. Well, guys, please take note. If the variable that will require it's a component in the cash flow items that form the calculations on the present value on each of the year and add it up to turn into net present value. Example of such component includes volume of sales, prices of sales and costs, as well as values such as fixed costs. When you are looking for such changes on these component items, the straightforward calculation to derive such X% is merely looking at the changes in the present value of these affected cash flow items. Guys, to turn the net present value from what it is currently to 0, the entire amount of NPV is hence reflecting changes required on the present value for these specific affected cash flow. Taking the change in the value, comparing to the original size of the present value based on the original estimate of these affected cash flow. This comparison will then turn into the form of percentage This percentage represents sensitivity on the project payoff given the change on this particular component of variable. Guys, however, should the question is asking, what about the sensitivity on the project's payoff given the change on the discount rate that is reflecting the weighted average cost of capital for the project? So what exactly the steps that were involved in deriving the X percent? Fundamentally, the formulation, the derivations of this percentage is still pretty much the same as before. By looking for the changes, this time, instead of present value, it is the changes in the discount rate that require to turn the NPV from where it is now to become zero, comparing to the current or the original discount rate in use. Guys, it is worth to mention, apart from deriving the percentage based upon the similar formulas as above, a much straightforward way to derive such a percentage is merely looking for a revised discount rate that will lead to zero NPV. Guys, do you aware discount rate that gives rise to zero amount of NPV is clearly reflected by the yield of the project, namely internal rate of return. So based upon the IRR that derive on the projects, you will then compare to the original discount rate. With this comparison, deduct by the principle of ones, that will give rise to the percentage of X percent as mentioned a moment ago. So that explains the two main steps in performing sensitivity analysis. As mentioned a moment ago, what's the purpose of such finding? And what are the underpinning limitations in this finding? Let's unveil the mystery of two of such theoretical discussion. First, the finding of sensitivity analysis will allow the decision maker in assessing the riskiness, the variability of the investment decisions they make. What exactly is the extent of risk that these decisions may expose to? In other words, sensitivity analysis allows the decision maker to figure out, to estimate what's the maximum tolerance limit about the adverse changes on such specific variable before the decision is being reverted. Once the riskiness of the variables on the decisions were known, these findings will help to identify among all the uncertain information, which of it is the riskiest factor. Alternatively, it may be called the critical success factor about the investment decision made. Why is it that decision maker or businesses may want to know the riskiest factor? By the way, it is worth to point out to you the riskiest factor is the one that requires a smallest X percent that turn the NPV into zero. The reason of knowing such the riskiest factor will lead the management to consider undertaking necessary risk mitigation or risk reduction initiatives to ensure and sustain the viability of such project. For instance, should selling price of the finished good produced in this project is proven to be the most sensitive variable, company may hence consider measures to stabilize the selling price of the product throughout the project life, ensuring the project is of remain viable. So that is the real purpose of knowing the sensitivity of the project's payoff regarding changes in ranges of specific variables. However, such finding may subject to ranges of assumption which they fall underpinned the underlying limitations of it. Firstly, the measurement of the sensitivities regarding the project payoff on a specific variable will need to only be possible to carry out by holding other variables remain unchanged. Well, guys, these may not seem to be realistic in the practice. Reason being, it is more likely that the interrelationship, the causalities of one variable and the other variable are related, which require a considerations on a multiple set of variables at the same goal in performing sensitivity analysis. Hence, such assumption is proving the sensitivity analysis in this context less realistic. Second, sensitivity analysis is not a decision-making technique. It does not lead the management on an answer whether a project is worth accepting. Rather, sensitivity analysis is only serving as a supporting role to a decision-making technique in use, such as NPV. This technique does not serve the purpose if it is used in isolation. Last but not least, this analysis does not consider the likelihood. It does not look at the probability of such percentage of changes on the variable that render the less practical risk assessment technique as such. Even though certain variable is proven to be the riskiest factor, what if the chances of these occurrence is remote and highly unlikely? It does not serve any extra efforts to investigate risk mitigation efforts that mentioned a moment ago. So that is the consequences of not able to consider the likelihood of such occurrence. And obviously, by spending your time going through the study hub, you may be able to discover some other relevant limitation and criticism on sensitivity analysis. So guys, time to take you through to some demonstration. There will be two demonstrations that discuss in this video. The first demonstration is based on activity 1 extracted from the study hub. Guys, pause the video, give a try on answering requirement A, B according to what is being asked. Well, after looking at information provided above, we know the questions is asking on the decisions to be made. With all the information given above, it is likely that these decisions will be made based on net present value by deriving the results using the discount rate and ranges of forecast cash flow. So with these initial calculations on NPV, here is the result. The NPV of this project turned to be positive value of $5,329, and that seems to justify the project is worth accepting given a positive NPV. However, let's not forget about each and every items of cash flows that incorporated in the calculation are merely a forecast, and therefore it may subject to change. And this gives rise to the part B of the questions that is asking for percentage changes required in the following factor that may cause a decision to be revised. That is something we have mentioned a moment ago. So we have ranges of factors that to be measured and examined its percentage of change required. Based upon the formulas and the steps discussed a moment ago, when we were to look at, take for instance, the first factor to be studied, initial investment interest, by looking for the size of NPV, that representing the change required on the present value for the affected cash flow. So the initial investment is represented by the value of $150,000 in year 0, turning into present value, it is still remain unchanged. Based upon the present value of the current estimate as the denominator, comparing the change in the present value and the base that gives rise to the percentage of change, reading to 3.6%. However, This finding is incomplete until you clearly understand the direction of the change. Given the nature of cash outflows for such item, initial investment, in order to turn the current positive NPV to zero, we're talking about a decline in the NPV. And to do so, we will expect the cash outflow need to be increased. How much will the cash outflow to be increased by on this item that will render the NPV drop from 5329 down to zero? And the answer is 3.6%. So therefore, we will expect to indicate with these words clearly, should initial investment is to increase by 3.6%, the project's NPV will be zero. That may render a decision to be revised. Similarly apply for each and every other factor that is asked to measure its sensitivity or percentage of change required. Guys, you may notice the formula in use for most of these cash flow components are pretty much the same, except the cost of capital, the discount rate. As mentioned a moment ago, you may want to determine the internal rate of return, which in this case, it turned out to be 15.7%. Comparing to the current discount rates in use, which is 15%, when you would like to express the percentage of change in the same manner as all the above items, you may just take 15.7% comparing to the current reading and then minus 1. So these will then turn the changes into the same manner of expressions in X percent of changes required. So these exercise and activity demonstrate what ranges of sensitivity analysis on what ranges of items that serve to be the purpose of practicing this question before the exam. Finally, let's take a look at the real exam questions as one of the multiple choice questions as mentioned. What exactly is the sensitivity of the NPV given the change in the sales volume? So based upon the formulas that we have derived, we have to first identify what are the changes in the present value on the affected item comparing to the present value of this item. Knowing that the changes in the present value is represented by the net present value of it. So that represents the changes. Comparing to what's the present value of the affected item that includes sales volume. Guys, spend some time, take a look at all the present value components that make up the NPV. And you will notice that among this list of items, sales volume is clearly included in the first two items, the sales and the variable costs. So instead of looking at the present value of these two, the questions already have provided the net results in terms of contribution. Next, by looking at the present value of the contribution, 24,550. These become the present value of the affected cash flow item as the base, comparing to the changes required, representing by NPV. The percentage that you found in this calculation will then give rise to the answer required in these questions. And once you have carried out this calculation, you will notice the last figure, 5.3%, representing the most likely answers for showing percentage of changes on the sales volume required to turn the NPV into zero. To be more precise, the sales volume will need to not only just to say change, but to decrease by 5.3% approximately to turn the NPV down to zero. So guys, with all this demonstration, I hope you will have a better way in unveiling the mystery on sensitivity analysis. With that, thank you for watching.